if you go to an exchange counter, let's say at a bank, and you wanted to go overseas and you needed $1, right? You take that US dollar from the exchange counter. Let's say the exchange rate is 14 rand is 14 to the rand, right? And what you need to do is purchase $1 at 14 rand. When you go to exchange counter, they'll probably sell it to you for 14 rand 10 cents. And if you go to the US and come back again, not spending that $1, and the exchange rate, let's say, is still at 14. Okay, so you need 14 rand to buy $1, and you want to sell that dollar back to them. They probably charge you, or they probably give you 13 rand 40 for it. Okay, 13 rand 90. Sorry, guys. So 13 rand 90. So that's 10 cents below the actual price that you might see on the news each and every day, the exchange rate. And when you want to buy, they'll put a markup of about 10 cents, for example. So the difference between those two prices is basically the spread. That's the simplest way I can explain what the spread actually is, the bid and the ask price. And if you missed previous session, last week's session, then you can just go through the video I did post it on the Telegram channel. Okay. Now the long and short. Taking a long position is buying, and taking a short position or going short means to sell an actual instrument. Okay. Now, when the price is moving up, you want to be a buyer, right? When you feel like the market or that particular instrument is going to appreciate in value, then you want to be long. And if you feel like that particular instrument is going to depreciate in value, then you want to be a short. Okay, or you want to take a short position, or you. All right. So now, when you're looking at currencies, there are currencies that okay. Sorry about that, guys. Just give me a moment. Okay, so like I said, I'm in a very noisy sort of place. I'm actually back home, so as you can imagine, there's so much going on right here. Okay, so what we're basically looking at is the currencies, right? There's currencies that are minor and there are major currencies. Okay, now major currencies are basically ones where the economy is doing well. Basically, those are first world countries in all cases, right? So you'd be talking the United States, the let's say Great Britain, the Eurozone as a whole, New Zealand, Australia, and Canada. And your minor, typical example would be the South African rand, right? I know I placed that there, but I think that was more of a typo than anything. And South African rand, let's say, okay, the pula from Botswana, that would be a minor. The Turkish lira, that would be a minor currency. And some other currencies, the major ones that I didn't mention are the Japanese yen. Okay, no, a lot of the more experienced guys will be familiar with the Japanese yen. Okay, now currencies are represented in symbols. Now the first two letters of the symbol represent the country that the currency belongs to. So these first two letters over here, the USD in the US rather, in the USD stands for United States, and then the D, the third letter, actually stands for dollar or the currency. Okay, so we have GBP, which is Great Britain, and then you have P, which is pound, right? Then you get your GBP. Okay. Now, well, obviously that is explained in a bit more detail in this paragraph that we actually have here. But it's very simple, very straightforward, and I don't think we need to elaborate more on that. Okay. Now, when it comes to the markets, we've been talking about buying when it goes up or shorting when it actually goes down. But we have to understand that at the end of the day, we need to have some sense or some way of actually measuring the amount of money we actually make, right? We need to be able to translate whatever money that we actually make, or firstly, some way of measurement to see how much we're actually making within the market. So hence we have the terminology PIP, all right? PIP stands for percentage in price, which is sort of like the smallest increment that we actually have in the market to measure a one move, right? So it's sort of like one move. So it's like a second, for example. Right now, the PIP is the fourth number after the decimal point. So if the currency or if the price of a currency is one spot, 25.48.7, then the 8 is the actual PIP, right? And the last digit, which is the fifth one after the decimal point in this example, is this 7 over here. That is the pipette, okay? All right, now the pipette is a fractional pip, so it's like a second, right? The pip is a second, and the pipette is like a millisecond. So we don't actually pay attention to them, right? So we just basically ignore them. And this is true for all currencies except for anything that involves the Japanese yen. Okay, so whether the Japanese yen is the base currency or the Japanese yen is the code currency, then the numbering system is a bit different. So just to use this particular example, if we can see that we have 4 digits after the decimal point, which is 1, 2, 3, 4. Remember, we ignore the seventh or the number 7, which is the fifth digit after the decimal point. In this instance, right, there are only 3 numbers after the decimal point. So it would be 1, 2, 5 spot, or rather 1, 2 spot, 5, 4, 8. Okay. All right. So let's use this example here. So instead of the 5 numbers after the decimal point, there are only 3 after the decimal point, with the second number, okay, this number 1 here being the pip, and the third number being the pipette. All right. So if we counting, for example, as I'll show you guys in when we're actually doing the platform orientation, where we'll be able to look at markets move and measure the amount of pips, potential pips we can actually make in a trade example, then you'll see how different it is from other markets, all right, when it comes to anything that does involve the Japanese yen in terms of just the way that it's numbered. Okay, you don't want to get too confused about that because it's a very basic and simple concept once you actually see it, right? When you're thinking about it, it can be a bit confusing, but when you actually see it, on your charts, then it's just basically makes sense, right? Now, this is a concept that a lot of people get confused with, and so I'll use as simple English that I humanly can. As you guys know, I don't like to use these words. I hate reading these words over and over again. Don't want things to get robotic. So, which is why I just use typical examples that everyone can understand. So, leverage is basically a loan that the broker gives to you, right? We discussed what a broker is and what the broker's job is, in a sense. And what they do is they provide you with a loan which says you can trade X amount of money if you deposit X amount of money into your trading account. So to make things practical, or to use an exact figure, let's say you're using a leverage of 1:100. Okay, so written in this way. I'm not sure if I have this as an example. Okay, let me just show this. All right, so when you're opening a trading account, what you'll see typically after you've decided, okay, am I going to put my real email address and my full name? There's a section where you actually have to pick which leverage you're typically going to use, and it's written like this. Can you just scroll down maybe? So this can be in a much, right, boom. Okay, there's an alarm going off, guys. I'm not quite sure where that's coming from. All right, so 1:100. So in this example, right, that we're going to use, okay, let's say then we have a $100 trading account, right? So $100 trading account, right? And we apply a leverage of 1:100. That basically means for each and every single dollar that we deposit into our trading account, the broker will allow us to control as much as for every dollar we deposit, they'll give us another $100 for us to trade around with. Okay, now you don't pay that money back, but the profits that you do make with that account or with that applied leverage on is yours, 100% of it. Okay, so leverage is quite necessary, because without leverage, as you'll see once you understand how many lots and contracts can be traded with a certain account size, then you'll see it will basically be impossible for the average retail trader to be able to trade anything on the market, right? Because you basically need $1,000 just to place one single trade of 0.01, which is a micro contract, right? So because that would be a 1:1 leverage. But since we have a 1:100 leverage, we can then trade way more than we have in our account. So we take this $100 and we'd multiply it by 100. All right. So with a leverage of 1:100 on a $100 trading account, what we'll see on our platform is $100, right? But what we can actually control in terms of amount of contracts that we can trade and all that stuff, we would have $10,000 available for us to trade with. Okay, so that is multiplied by 100. Now that $100 multiplied by that 100 leverage, 1:100 leverage, gives us $10,000. Now at $10,000, we can basically trade about 10 micro contracts, right? Micro contracts are being 1,000 units or $1,000, or one mini contract being 0.10, right? And that basically means we can buy at least one $10,000 contract, or 10,000 units or $10,000. Okay, so what you're going to see on your platform is you're going to see your $100, but what you can actually trade with is your $100 multiplied by whatever leverage you apply. So typically I'd say 1:200 is a really good leverage. You don't want to apply too much leverage because of a concept that we'll go through in the very next section. But a leverage of about 1:200 is sufficient for you to actually trade with, because too low of a leverage, you can't really trade much. and too high of a leverage, you put way too much of your account at risk. Okay. Right. Okay. So now margin, as I'll explain it in my sense, in the way that I'd like everyone to understand it in the most simplest way ever, is sort of like a minimum amount of money that the broker requires for you to maintain your account at all times, what it needs to be open. So if, for example, it's like your minimum balance on your bank account, right? So your balance, your available funds might be, let's say, 10,000 Rand. Okay, so your available funds will be 10,000 Rand, but your balance is, let's say, 15,000 Rand. Okay, so obviously that 5,000 Rand is sort of like the amount that you need to keep that account open, right? Believe it or not, obviously there are accounts that would require such. And that is a percentage that you need to keep that account open. So in an FX terminology, or in an FX sense, let's say we have 1,000 USD in our account, and the broker requires a 20% margin, right? So 20% of 1,000 US dollars, that's like 200 USD, and that is the amount that you actually need to have to keep those trades of yours going. Because here's the thing, once you exceed, let's say you are losing 800 or let's say 799 USD, okay, on your $1,000 account, your account might start, or your platform might start flashing and all of that stuff, and that is when the account goes into a margin call, because now there's not enough margin to keep those losing trades that you might have on your platform running, which is then when it goes to that minus 200 or minus 800 USD, okay, and you're only left with 200 USD, right? The broker will close your positions. Boom. Okay. Because now you've reached that 20% margin level, margin requirement, you've actually violated it, and then the broker executes what's called a margin call. Right, back in the day, they used to literally give you a call, which is why it's called a margin call. They would call you and ask you to deposit more funds into that trading account of yours. But now they don't need to do that. They'll just close all your losing trades without telling you anything, without sending you an email or anything of the sort. Okay. So just make sure that you understand what the margin levels are for whatever broker that you're currently using. And once you've established that, just make sure that whatever positions that you actually have don't come close to that, right? You don't want to try and borderline on it. You just don't want to come close to those margin requirements, those minimum margin requirements. Okay. Now, there's different types of orders that you can enter or exit the market, right? So typically, we'll just say 5 of the most commonly used ones. And a market order is, let's say, when we looking at the market, let's say we're looking at the USD JPY, right? So we're looking at the dollar versus the Japanese yen, and it's called an instant execution because once we look at that market and we decide right there and then, we click buy or we click sell, then the trade is executed immediately. All right. So that is the best available price. Obviously, there's stuff that happens behind the doors when we click that buy or sell, but typically that we get an instant execution, which is why it's called an instant execution order or a market execution order on our MT4 platform. So that's typically what most people would be doing once they have decided whether to buy or sell, because you need to be in front of your platform and you need to actually be watching the charts in order for you to be able to do so. Okay. So pending order There are different types of pending orders, but a pending order typically is an order to place to be placed either below or above what the price is right now. So, for example, a pending order, let's say this is the price, right? So the red is the price, and our pending order could typically go up here, right, above the market price if we believe the market is going to continue to go higher, right? Or we can place it below the market price if we believe that the price will drop and continue to drop once it's reached our pending order over here. Okay. Now there's two types of pending orders, which is a limit entry, okay, and you buy below or above the market price at a certain level. Okay, so let's say our level that we're looking for. I like to use examples on the USD ZAR because it's very easy to relate to. So the South African Rand versus the US dollar. So let's say typically we have the price at 14 Rand. Okay, let's say the price is trading at 14 Rand. Okay. All right. And we believe that the price will continue to rise to 15 Rand, for example. Okay, we're just using arbitrary numbers here because they're very easy to relate to. And we have 13 Rand over here. I know my drawings are terrible, guys, but I'm just hoping you guys can make out a bit of it. So we have the price at 14 Rand, right? We believe if the price reaches 14 Rand, it will continue going higher to 15 Rand. So what we use is, in this entry, in this example, is a stop entry. Okay. And to be specific, there are two types of stop entries, right? A buy stop and a sell stop. So in this instance, we'll use a buy stop. This is right, BS. Okay, so if the price reaches 14 Rand, it will activate our buy stop, right? And if the price continues to go up, obviously we're going to be making some money there, and we will exit at 15 Rand, making that 1 Rand profit. Okay, let's just say that 1 Rand price change. Now, if we believe that the price was actually going to go down from 15 Rand, for example, to 14 Rand, and once it reaches 14 Rand again, we'd expect the price to drop down to 13 Rand. We'd use a sell stop. Okay, we'd use a sell stop in line with the direction that we want the market to go to. All right. So that sell stop comes below where the price actually is. All right. All right. And let's say if from 13 Rand to 12 Rand, we believe that the price will continue to drop, then we'll place another sell stop at 13 Rand to 12 Rand. All right. Now, a limit entry is a bit different, but it does more or less the same job in that it allows us to enter the market even if we are away from the charts, because a stop entry, you place it above or below the price and you can leave it. The broker will execute whether you are there or not, you are sleeping, on vacation, whatever the case may be, the broker will execute at that particular price that you said, whether you're there or not. Okay, it doesn't matter to them. They'll just execute that order as long as you still have funds in your account. Now, a limit entry is a bit different in the sense that it's used for when the price is about to turn. So in this example, we're going to use, right, let me just try and use straight lines, guys. maybe that's going to be a bit better because my drawings are terrible. Okay, so let's say the price rises up and we have, let me do a text over here. Let's see if this is going to work. Right, 14 Rand. Okay, wow, I think I should have done this earlier. 15, and we believe that the price might go to 16 Rand. Right, so the US dollar to the Rand might be 14, and right now we're looking at it going to 16. Right, so what we do is we place a sell limit. Okay, let me change the color of my sell limit to, let's say, perhaps a yellow. Right, so once it reaches this 16 Rand level, we'd like to see the price, the market, okay, just move higher into that 16 Rand range and then reverse down to, let's say, 15 Rand. Okay, so there we'd place a sell limit. So the sell limit would go above the market price, okay? And there, let's say at 15 Rand, we'd basically have our take profit and would exit the market at 15 Rand with a profit of about 1 Rand price change. And let's say at 15 Rand, we believe the price will then turn back up and head upwards to 16 Rand again. What we do then is we place another limit order, but this time we'd place a buy limit. Okay, so we'd place a buy limit. Okay, so we place a buy. Let me change color to black again. Buy limit. And sure enough, if the market reaches that level, boom, triggers that 15 Rand level and then heads upward, then we're going to be making some money over there. Okay, on that buy limit. So on a buy limit, the price needs to be above that buy limit. Okay. So we're going to go through, obviously, on I think it's the fourth part of the module where we actually take trades and we place stop losses, we place pending orders. So if this is not making a lot of sense right now, you shouldn't be worried because we're going to go through practically how it actually works out. Okay, you'll be able to see. Now, the stop loss is one of the other orders that we typically have. It is, to me, the most important one because it actually limits your losses. So what would happen in a typical stop loss example would be, let's say you have price at one, okay, let's just say 14 Rand. Right, so 14 Rand, and over here we have 13 Rand, and over there we have 15 Rand. Right, so if, for example, we believe that the price at 14 Rand, if the market price goes from 13 Rand to 14 Rand, and at 14 Rand we're willing to buy and catch it to 15 Rand, then we obviously have to have, okay, let me try and change this to black. Okay, so this is our buy area, right? We're going to put our buy stop at 14 Rand, but if the market does go up to 15 Rand, we're going to use a take profit, right? A take profit is where we have our target at, right? And that's where point where we're like, okay, this is where I'm satisfied with, or this is how much the strategy itself actually provides in potential profits. Therefore, I'll place my take profit there, okay? So in this example, let's say we do reach that 15 Rand, the price will, or the market will get Okay, so let's say we reach that 15 Rand level, we're going to get taken out, right? The broker is going to automatically take us out with whatever profits we've made from 14 Rand to 15 Rand. Now, if that doesn't happen, right, and the market goes up just a bit and then heads downward, right, we need to have a point where we actually get out. That's where stop loss comes in. Now, stop loss is, to me, as I said, the most important order because it provides us with the ability to come back another day if we do get the direction of the market wrong. Okay, so you typically put a stop loss in an area where it's less likely to get triggered and the market goes in your intended direction, but more of that on that once we get to strategy. At 14 Rand, price goes up a bit. And let's say now we use 13 Rand as our stop loss area. So we are like, okay, if the price reaches, if the market does reach 14 Rand, but triggers our buy stop and then goes and drops immediately after that, then we'd like to get out at a point where we feel comfortable with that particular loss. So you don't want the whole $1,000 trading account, for example, withering away or just like saying, okay, I'm just going to wait for the market to come back, whether it be now or next year or the year after that, because typically most retail traders don't have large enough account sizes to wait for those types of reversals. So that stop loss will basically be something that's very important in that if it's triggered, you get out of that trade, yes, with a loss, but with a calculated loss. So you have anticipated how much you're potentially willing to risk for that particular trade to see if it's going to work out. And if it doesn't work out, you already have a predefined figure in your head and on your platform that says, I'm going to lose this amount if this trade doesn't work out the way that I initially planned. Okay, so when this happens, boom, the broker will then take you out of that position, whether you like it or not, as long as the stop loss is there at that price, right? Typically, but somewhere around that price, depending on what broker you choose. And if you do get that price, then at least you are out of the market, whether you are in front of the laptop, not in front of the laptop, on holiday, whatever the case may be, you know that the trade is closed now, okay? And you have a predefined risk amount that you place on each and every single trade. So every single order that you place will and should have a stop loss because it helps us to avoid blowing out the account in a single bad trade idea, right? What you want to do is when it comes to making money in the markets, the most important thing is to obviously have money that you can use to come back for and trade with, let's say, the following day, right? So if there's a situation where you have no money, let's say you have $1,000, you lose $100 today, right? You still have $900 to typically come back with the following day in order for you to try and recoup, even if it's not tomorrow, but just to come back and try and recoup whatever money that you actually made, right? But if you blow out the entire $1,000 stake, then you have nothing to come back with, and you need to deposit more money into your account, which is sort of like counterproductive. Okay. So I do believe we have less than a minute left in this particular session. So if there are any questions, guys, you can quickly shoot them through. If not, I will be hosting the advanced session tomorrow at 7 p.m. And I will upload this again, right? Because I do have a session like this that we've done previously. Probably, I'm not sure if it was 2 or 3 months ago, but it's very similar to this one. But I will